Optimism about the global economic recovery continues to fuel the rising stock market. Not surprisingly, that creates some opportunities for investors, but perhaps some pitfalls. My next guest tells us where investors can truly gain in 2011. Christian Thwaites is the president and chief executive of Sentinel Investments, managing about $27 billion. He is bullish on some stocks and indeed on some bonds. Christian, good to have you with us on Bloomberg once again. Now, before we go to stocks, I want to get your thoughts on bonds, because when I was reading the notes, I was surprised. You actually think that bonds, at least some bonds, are still a good bet for investors. Don't just run away from bonds, generally speaking.
No, please don't. Because since the QE2, we've had
the quantitative easing, the Federal Reserve coming in and saying they're going to buy about $600 billion worth of U.S. Treasuries.
Yes, so we saw the benchmarked 10-year Treasury note lose about 50, 60 basis points in yield, go from about 2.8 to 3.3. But we think that's going to snap back pretty much in the beginning part of the early year, primarily because this time of year, the last sort of 6 weeks of the year, a lot of banks, a lot of trading desks reposition their books for year end. So they're natural sellers of particularly Treasury benchmark bonds, and also want to clean up their balance sheets by the year end.
Well, so when you say that, you can offer a little more detail. When you say clean up their balance sheets, selling U.S. Treasuries, what does that do? Just liquefies the balance sheet even more, or why would they be closing out those positions? Because they can make money on them?
They're booking the profits which they made through the course of the year. I don't think any traders sort of going into December wanted to make sure that the gains that they'd had, which at that point were about an annualized rate of about 8 or 9%, were locked in for the year. So they were natural sellers.
Because the meter starts for their performance review January the 1st.
12/31. So they were looking to shrink their balance sheets and their trading positions. So there was a lot of forced sellers, sort of unnatural sellers in December, which we think contributed a lot to the Treasury weakness. We think that'll snap back in January the other way. And we had the same position exactly happened at the end of 2009, where rates moved up from about 3.4 to 3.9, and then, as we know, sort of came back quite sharply in the first half of the year.
So we might be kidding ourselves a little bit if we attribute all of the decline in yield, the increase in price, to what the Federal Reserve has been doing. I mean, that may contribute, but it doesn't necessarily speak to what happened, let's say, in 2009, same time period, same situation.
Yes, I think a lot of it's technical. There's just a lot of liquidity in the market, and I think there's a lot of pent-up liquidity, and they'll be back buying in January. And so that we see quite a nice rally coming through in Treasuries in January or February.
And are we talking short-term, medium-term, or all the way out 30 years?
Well, I think mostly around this sort of 10 to 15-year bracket, maturity for most of the bonds, and we think that rally will last about 3 to 6 months. So we're sort of in the camp that rates will be, around where they are and a little bit lower in the first quarter of the year, and then they might have come under some pressure then. But for now, the Fed has made it very, very clear that they want the rates to stay low, and I think the market's going to stay with that, and they're not going to fight against it.
All right. Well, let me lead you slowly into equities, because the notion that bonds, at least some bonds, might do well in the first half of 2011 doesn't necessarily mean that you want to avoid stocks, right?
No. I think it's one of those where it's not an either-or decision. I think it's okay to be in fixed income securities, and I think also the equity markets represent still some good value. And we've had quite a year, as you know. So we sort of started up 12, down 17, up 20%. So it's been quite volatile. Interesting enough, the VIX, the volatility index, has barely traded above 40 all year. So the implied volatility has been low. The actual volatility has been quite high.
How can you have that? Why does that situation exist? It seems almost contradictory.
Because the VIX often sort of gets out, is traded almost as a separate commodity.
And those are the options traders. Those are people who are buying puts and calls on the volatility on the S&P 500.
Yes, and it has its own instruments sort of driven by what people think might happen. But the actual people expected volatility to be low. It actually was quite high. And we think that's going to be the pattern for 2010. So we will get there with perhaps another 10 or 11% increase, but it won't be a very easy ride.
Christian, let's talk about something everyday. Kitchen equipment. Now, I mean commercial kitchen equipment, although if you have the desire, you can actually buy one of their toasters for your home. These are the toasters that you maybe see in delicatessens, where the bread kind of moves through the conveyor belt. This is Middleby. How did you come up with Middleby?
Middleby's a great company based out in Illinois. It's one of these companies which you don't know that you use almost every day. It's in 1 out of every 3 restaurants in the world. And basically it makes the cooking equipment or storage equipment, freezing, fryers, convection ovens.
Yeah, I looked at the list of the things they had, and I tried to think of reasons to buy all of the things that they're offering, convection ovens as well as warming stations.
Well, you'd buy them if you were sort of into the fast food franchise. In fact, their biggest customers are people like Kentucky Fried Chicken and Domino's Pizza. And of course, they'd be able to, and the Yum brand's able to follow them globally. And they're a very efficient manufacturer with about 40% margins. But the important thing that we think they're going into a very interesting growth phase is they're able to offer a lot of sort of energy and labor-saving devices. So they can construct pizza ovens, for example, which can take a pizza from basically the dough stage to fully cooked in about 4 minutes. They can also have steaming ovens without the piping and plumbing, and they can have convection heatings which kind of go from dormant sort of energy-saving status through to full cooking in about 3 or 4 minutes. So their throughput time and their labor-saving benefits are enormous.
And the brands are people know, right? I mean, you're talking about Turbo Chef or whether it's Toastmaster. So there are a lot of brands that are out there that are under the Middleby banner.
Another one is Blodgett. And quite often, if you look through sort of your Domino's or your KFC store through to the back, you'll see them. And because they're major supplier to these companies, they're a pure play. The only sort of real thing that worries them is the cost of steel, which is really sort of an energy input. But other than that, I said their margins are high, 40%. Very good management. You know, the president CEO owns about 5% of it, which we like to see. It's still a small cap stock, $1.5 billion market cap, and it's going to be growing sort of 16–20% this year. So it's an interesting company that not a lot of people know about, but has got really good, strong, proven management track record.
Let me take you all the way to Hong Kong for a company that at least many people in Asia know about, and this is Li & Fung. This is a big sourcing company. I mean, if you want to make something, if you've got an idea for a product, eventually you're going to talk to somebody at Li & Fung, it seems.
Yes, Li & Fung is about a 100-year-old Hong Kong-based company with enormous sort of contacts into mainland China. Their biggest clients here in the West are people like Walmart, Target, and Marks & Spencer in the UK, one of the biggest apparel as well as food retailers. And essentially they will sort of be a middleman between sourcing products in China to their Western counterparts. And they can move their manufacturing and their labor so pretty much all over China and all over Asia. And they're really now a play on Asian growth, and particularly in China, and particularly again the Chinese consumer, which is a very strong long-term theme for us, and we think Li & Fung is going to be a beneficiary of it.
So you get the domestic growth in China plus their ability to source for all over the world.
Yes, and every time a company like Walmart announces sort of better margins or a broader range of products, if they're being sourced from Asia, Li & Fung is involved, and so it's a very sort of strong way to play the consumer discretionary market in the West as well.
Now I want to give you a little bit of time to talk about a medical device company that makes disposable syringes, various types of medical instruments. Medtronic has a 20% stake in it. This is also a Chinese company, Weizhou.
Yes, Shandong Weigao makes medical device companies.
You say it a lot better than I do.
The interesting thing about this is it's a wonderful play on the Chinese healthcare trends. This is going to be a very major trend in the next 5 to 10 years as Chinese individuals take more responsibility for their own healthcare. And this is a company which makes single-use devices. So it's anything from catheters to sterilizing needles to disposables. So it's very difficult to get a company to displace, and it's got one of the best managements in the business, and it's growing at about 30% a year, and that's roughly what the price earnings to growth ratio is. So it's a little bit expensive in its our normal terms, but a great place to be.
Christian Thwaites, always a pleasure. Sentinel Investments, thank you very much.